Okay, we have our first set of guests with us. Ed Yardeni, president at Yardeni Research, is with us. James Knightley, chief international economist at ING, is with us as well. Gentlemen, thank you for waiting longer than usual. We were getting done with everything which has happened. Ed, a simple question. Obviously, these are much harsher than the worst estimates that I saw out there in the street. Hope is they will be negotiated lower, but your first thoughts?
Well, back a few days ago on Monday, I wrote a piece characterizing this as the reign of tariffs, Trump's reign of tariffs, and I actually lowered my outlook for where the S&P 500 might end up the year, lowered it from 6,400 to 6,000, and today that may look a little too optimistic given the reaction of the markets. But my first thoughts are that this is not a good policy. This is a very bad policy, and the only good thing is that maybe there'll be negotiations that will reciprocally lower tariffs. We don't want these tariffs to remain intact. So lowering tariffs may be the outcome of negotiations. The problem is that there's still a 10% tariff, which is apparently a tariff that won't go away. And I think the Trump administration intends to raise $300 to $600 billion at an annual rate with this tariff, and that may still be too high for some countries.
James, your first thoughts, and just one specific thing. You know, these tariffs, these reciprocal tariffs include non-tariff barriers as well. So, for example, in the case of India, the table will come up. They're saying the tariffs charged to US is 52%. Now, that is their estimate of, VAT, forex, currency, and other things, right? So, in this, what Ed is saying, that maybe tariffs go down for everyone. But the point is, there is a limit to how much you can cut tariffs and then hope for Trump to lower his tariffs as well, because it is not entirely just tariffs. It is their estimate of all these non-tariff barriers as well. James, go on.
I would cast some doubt on that, because there's a growing story here in the United States that actually, where did these numbers come from? Because if you look at some of those numbers, like 97% charged by Cambodia, it's raised a few eyebrows as to where these numbers are really coming from. But someone has come up with the solution, and you can run through this. And basically, what they've done is they've taken the trade deficit. So they've come up with this idea that it is this tariff rates plus non-tariff barriers. But what we've got is it's basically looking at the ratio of exports to the US divided by the trade balance. And if you run through that and look at all the countries, that is exactly what they've done. These aren't a scientific calculation of all the trade tariffs and all the barriers at all. It's seemingly somewhat of a fabricated number. And then to say, well, we're going to charge every country 50% of this. Again, it does suggest that this is, you would hope that political leaders around the world are going to pick up on this and think, hang on, this is not what we charge you whatsoever. So I think that there could be some reasonable scope for some renegotiations here, as a lot of countries make the point that these numbers do not match up with reality, basically. So that gives me some hope that we will get a recalibration. But, this is Donald Trump, and we've got to be prepared for
we saw that.
volatility.
We've seen that. I think Ed must have also seen it, right? That ratio.
Yeah.
So, as you said, it looks like a fabricated number. So then if they've just pulled this out of thin air, how should one read this? That they just want a high number somehow. So you get to that high number, but then they're willing to backtrack and lower it far lower, or they just want to go ahead. Ed.
Well, look, I think the most important story here is that we're still talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here, because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4% because of these ridiculous tariffs. And the notion that foreigners pay tariffs is absurd. The reality is Americans are going to pay the tariff, and it'll be mostly American consumers. And they're already very angry about the inflation they've experienced during the Biden years. And they were promised by the administration, this administration, that they would lower prices. And it's going to go quite the opposite way. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
So we're seeing some of that, right? By the way, the U.S. 10-year yield, it's cooled off. It's now almost at the 4% mark as we're seeing that flight to safety play out. Gentlemen, so two-part question. Let's first talk about the impact. For now, whether these are scientific numbers or not, they are the numbers. He's just declared them, so we have to deal with them, right? So, Mr. Yardeni, you said you've lowered your estimates for the S&P 500. What about the U.S. economy itself? Do you believe? Because earlier you were very, very confident about the health of the economy. Do you believe that a recession could be a reality now?
Well, the extraordinary thing is how well the economy performed over the past 3 years in the face of a significant tightening of monetary policy. I was one of the few economists who said that we would not be a recession. And so I'm kind of still hoping that the economy will prove its resilience. But this is a major, major stress test. And I've lowered my expectations for this year. I haven't lowered my expectations for the rest of the decade. I still think there's a chance that we'll have what I've called the roaring 2020s. But that doesn't look very realistic right here. So I've lowered my numbers to about 1.5% real GDP growth this year. And I was thinking it could do like what it did last year, which is 2.5% to 3%. And we could have a very strange year where growth is maybe 1% or less in the first quarter. Then it could be up 3% in the second quarter because people are buying cars left and right before the tariffs drive up car prices. And then in the second half of the year, we could have a real slump led by weaker consumer spending.
1.5% best case U.S. growth for 2025. Got that. James, similar question to try and map the growth implications for Asian exporters, right? Because Trump is trying to shift the world's axis. He's saying, the U.S. needs to manufacture. So countries like South Korea, China for that matter, manufacturing was all about Asia. It was the Asian tiger, so to speak, right? How much immediately in this year would you expect the growth impact to be for Asia?
Well, we're already seeing a reaction from the US consumer. We stand a very real possibility that we have negative consumer spending growth in this first quarter, as Ed alluded to. And I think in this environment where we've got households that are very worried about their spending power, and that's going to be intensified by the effects of the tariffs. We've got households worried about austerity. What does that mean for jobs? What does that mean for entitlements? And then if you overlay that with the third threat, which is sliding equity markets and perhaps possibly declining wealth levels in America, it's a pretty poor recipe for growth, certainly this year. For the US economy. So that does translate, we would fear, into, we've had this wave of imports to try and preempt some of the tariffs, that we do see much weaker exports into the US later on this year. I think certainly, it's going to be years away before we see meaningful reshoring to the United States. So there will obviously still be plenty of opportunities. But the big fear is not necessarily the tariffs itself for these Asian exporters. It's much more going to be what is the US consumer doing and what is the knock-on for the rest of the world in terms of the global growth story.
Mm-hmm. Well, I'll take that point, James, and it'll be interesting to see if they're going to be getting additional revenue. That's the U.S. administration. What do? Do they go ahead and they implement some tax cuts so to keep the economy afloat? But James, earlier when we had spoken, you were factoring in a couple of rate cuts from the Fed. That goes out of the window now for 2025 itself?
No, I don't think so. Again, Ed's probably got a more upbeat medium to longer term view on the US consumer than I perhaps do, so therefore perhaps feels that inflation is more sustainable. But I'm more of the mindset, well, these tariffs are probably going to be a one-off. I would hope they're going to be a one-off, and that we could potentially see them either rolled back in coming weeks or potentially rolled back in subsequent months. So there certainly is going to be a near-term spike up in inflation, but in 12 to 18 months' time, are we going to be in that sort of still lingering at 3 to 4%. I'm doubtful, and I think the Fed being somewhat forward-looking. Okay, they have already implemented 100 basis points of rate cuts, but I think they'll be looking at the more pessimistic outlook for US growth that analysts are having, and they presumably themselves are having as well, and are looking medium to longer term. What is inflation going to be in, say, 18 months' time down to perhaps 2 years' time? And therefore, there's still, I think, scope for 2 rate cuts that we have. We've got I think near term, the Fed are going to be hesitant. We've got a September rate cut and a December rate cut and a March 2026 rate cut. I'm still sticking to that for now. And it is more the growth story looking at more negative in an environment where inflation is higher.
All right, so you're sticking to that Fed rate cut forecast that you gave us earlier. Before we wind up, Ed, 6,500 on the S&P 500, lower to around 6,000. What should it look like, give and take whatever we have, what we've heard from President Trump? He was supposed to be good for the US markets, but it seems, as of now, it's likely to get into a bit of a tizzy. What should be the number we're looking at on the S&P 500?
Well, I've lowered it quite a bit. I started out the year optimistic, thinking that Trump would get it right. Instead, he seems to be getting it very wrong. And I had 7,000 by the end of the year with strong earnings and valuation multiples staying up. But like everybody else, I've lost my confidence in Trump's ability to do this right. And as a result, a couple of weeks ago lowered it to 6,400 on the S&P. Now I'm down to 6,100, 6,000, 6,100. I think that's still a realistic, achievable goal, but I think it's going to require that either we negotiate a lot of tariff reductions or the president declares victory one way or the other and backs off of this potentially disastrous policy.
No, got that. James, one last question. I'm still sort of looking at the basics, right? You said you started with that number, that starting point is kind of, you said fabricated. Have you confirmed that, because it's all over, and I think it's a theory in the US as well. Is that confirmed, and how does that work? So, for example, India, our exports to US are about $91 billion. India runs a surplus. So US runs a deficit of about $40 billion. So, what is this formula, this fabricated formula? In that sense.
So it's the 40 divided by the 90 to give you the sort of rough 50%, and therefore halve that, and you get to about a 26% tariff that is being applied to India.
And it looks like this is what they've done, or it's just sort of coincidental
you can get the same number. So for the EU, the ratio works out at about 40%, 39%, I think it is. And so what they've done is basically halved it and given you a 20% tariff. For countries where they are running a trade surplus, where the US runs a trade surplus, so for example, the UK runs a trade surplus, but it therefore gets the minimum 10% tariff.
Got that. So I asked Ed this, if they've pulled this out of thin air, so like they wanted to be very maximalist in their opening move. So say 52 and say we're only imposing 26. So does that mean anything from a very near-term market perspective, James?
Well, I think it means it suggests that political leaders around the world have got some scope for negotiation, saying, well, that's not actually the number, and coming up and proving it, and therefore they've got perhaps a little bit of leeway. But we come back to the point that Donald Trump actually really needs the cash if he's going to he needs the fiscal headroom to be in order to enact these extended and expanded tax cuts that he's promised us all. So he needs the money as well. So that's got to be coming into the thinking too.
All right. Gentlemen, thank you very much. I reckon it's been a long day for both of you, and I think it continues to be a longer day for us here. Thank you very much for staying up. Thank you for joining us, Ed and James. Great to speak with both of you here on CNBC TV 18.